Good afternoon, everyone. We're going to let everyone load into our chat room or our webinar, and then we'll get started in just a couple of seconds. Okay, it looks like our numbers are slowing down. Good afternoon, and welcome to Long-Term Care's Financial Impact and Planning. This is our last webinar in our series for the fall of 2025. We are glad that you're here. Just a few quick Zoom housekeeping notes. You are muted and your cameras are off for better sound quality. Please use the question and answer panel at any time. We'll have time at the end to get questions answered. If your question is not answered, we do have a record of those and we will reach back out to you after the webinar has concluded. You'll see a couple of polls that pop up during our event. Please respond to those, especially if you're here for CPE. Answering those is required for credit. We are recording this session and we will email the recording link and the slides and resources along with the CPE form after the event. Today's speaker is Bob Petkoff. He is the Chief Marketing Director with the Core Group. The Core Group is an insurance partner to HSC Wealth Management Partner, Avantax Planning Partners. They have been around for over 20 years and have helped clients in a variety of areas. Today, I'd like to introduce you to Bob, who will share more about what they do and how together we can address your specific needs. Again, thank you for joining us today. Bob, let's go ahead and get started.
Thank you, Leslie. I appreciate the opportunity. And yes, I'm Bob Petkoff. I'm Chief Marketing Officer, but I'm also one of the founding partners of the Core Group. We are celebrating our 26th anniversary this month. We built Core to support in the risk management area CPAs, estate planning attorneys, and financial professionals with education, case design, and a lot of support. So with that, let's get started. We're going to talk about a very important topic, long-term care. This hopefully will be educational for you from both a what it is to how do we hedge the risk. So our overview is quite comprehensive. What is long-term care? Where can I get long-term care services, protecting relationships, costs, who pays for what, favorable tax treatments. There's significant incentives, things to consider, and what works best for you, which is always important. Next slide, please. So what is long-term care? Long-term care is when you no longer are able to care for yourself, maintain the quality of life, and to live independently. A chronic illness event requires you to be unable to perform 2 of 6 ADLs, which are activities of daily living. And this also includes cognitive. So and what can cause these are a myriad of things, from old age to accidents, medical conditions, sickness, or like I said before, severe cognitive, and severe cognitive is can be either dementia or Alzheimer's, or just anything that's diagnosed as a cognitive deficiency that you can't live independently on your own safely. So on the right-hand slide, you'll see what the technical term is for ADLs: eating, being able to cook for yourself, continence, transferring, which is being able to get up and down and move around, toileting, bathing, and dressing. But there's a seventh, and that is the cognitive part of it. You could do all of those on your own, but you could have a cognitive deficiency, which would qualify you for some kind of long-term care support. And we're seeing more and more of that today than ever before. Next slide, Leslie. So where can I get long-term care services? It's a personal assistance to help you stay at home, stay safe, and maintain your quality of life. You can do it at home. There are assisted living communities. There are adult daycare facilities. There are nursing homes. And then obviously there's at the end, it's hospice care. I think we have a poll that we're going to share now.
We do.
We
Where would you prefer to receive care if you ever needed long-term care? And Bob, we had this conversation, and I think you are going to be spot on with the answer that we discussed. I'll give it just another couple of seconds while we see a few more people answering. Okay, I'm going to close it in 3, 2, 1. And I will let you speak to this, Bob. It looks like the answer we discussed earlier is what everyone chose here as well.
So let me go with the not sures. I know one person in particular who just goes from cruise ship to cruise ship, and it is cheaper than going into an assisted living facility. As long as she can do it, she's going to do it. It's one of my friend's mothers. She's 83 years old. She would qualify for long-term care, but she chose to just, so she's the other, or not sure. But the typical number is about 75% would like to stay at home as long as they possibly can. And I've experienced that personally with my in-laws. They're definitely ready, but they're not ready to move. So thank you. Next slide, please. So what are the odds? This is well, the first time I saw this slide, I was kind of set back. So the odds of you having a house fire in any one year is 1 in 365. That's I thought that's a little bit lower than I thought. Odds of getting in a car accident are 1 in 63. Well, I don't know if your roads are like our roads, but I see an accident every day. So I can understand that. And we have car insurance and we have home insurance on always. Odds of having an extended healthcare event that would be considered long-term care is 1 in 2, 50%. And I've seen numbers as high as 70%, that 70% will have some kind of a long-term care stay. If any of you have acted in the role, or your spouse has acted in a role, or your parents have acted in the role of a caregiver, these statistics will hit home. 64% of caregivers have some form of depression at some point. 70% report missing work. We saw this a lot during COVID, where we couldn't find and clients couldn't find caregivers to come into the home because of COVID, and family members had to shut down and not work and go and care for their parents because of the lack of accessibility. 59% of caregivers have at least one chronic physical condition on their own. The average loss of income is over $300,000. These are all consequential things that we don't consider when we just like, oh, the kids will take care of mom, or the grandkids will help out. Average annual caregiver out-of-pocket expense, just what they pay for themselves. It could be gas back and forth, meals, things like that. It's over $7,000. And 87% of people surveyed, long-term care costs would be a significant financial threat to them if they had a long-term care stay. I can't stress enough the importance of having a professional care for a family member, or help at least, or be there to give you as a son or a daughter or grandchild a break at times as well. I have a 36-year-old special need daughter, and my wife's the caregiver. I see what that's like every day. I come home and I take over. So it's personal to me to make sure that we have the resources in place and I can educate as many people as I can to the resources that are available should you get in that position or a loved one, a parent or a grandparent gets in that position. Next slide, please. So what are the financial costs? And after this slide, I've got some statistics. I think most of our participants on the call are either in Indiana or Kentucky. Is that correct? So I pulled numbers from both Indiana and Kentucky for 2024 so that I can make it a little more personal. But here's the financial cost. Home health care, 51% of all long-term care services are provided in the home. 2025's numbers on average through the country is average of 60, almost 67, $68,000 and projected to be 110,000. You know, I'm not sure, I don't know if you're aware of this or not, but we have over 10,000 people a day turning 65 right now. This baby boomer bubble that's coming through. I think I saw that like last month, it was the largest number. It was almost 11,000 a day, not a month, a day are turning 65. Community care assisted living is very similar to in-home care. As far as cost goes, 66,000 is the average, projected to go up to 107,000. Skilled nursing, LTC claims are growing in this area. 15% of the claims last over the last 5 years versus 4.5% 10 years ago. Average is $127,000. That's $10,000 a month for a semi-private room. Semi-private means mom or dad has a roommate. It could be their spouse, but it could be somebody else as well. And that's growing, projected to grow to over 200,000 by 2035. Long-term care and costs aggregate. So if we have 1 year at home, a couple years in assisted living, and then 1 year and a half in skilled care, we're looking at a little over $425,000 all in. And 2035, 10 years from now, almost $700,000. The percentage of inflation in this area, let's just think about what I said before. If we have 10,000 people a day turning 65, it's been like that for a few years. It's going to continue to be like that for a few more years. We're living longer, we're living healthier, but just sheer massive number of people coming through this pipeline and what that means. Now let's talk about Indiana and Kentucky because the numbers are very similar. In-home care in Indiana for 2024 and Kentucky were right at $73,000 a year. Home health care, Indiana was like 75,000, Kentucky was 77,000. Adult daycare, both around $22,000. Adult daycare is you take mom or dad to a facility and they stay for the day and then you pick them up, kind of like kids daycare. Assisted living, Indiana was 64,000. Kentucky was 58,800. Semi-private rooms, 101,000 in Indiana and 104,000 in Kentucky. Private rooms, 124,000, so they kind of flipped for Indiana and 119,000 a year in Kentucky. That comes down to the daily cost of about today of a semi-private room is about $280 a day. Next slide, Leslie. So who pays for this? We'll talk about private coverage. We'll talk about government plans, and then we'll really dig into the meat of the conversation. But if you had a claim while you're still working and you needed a long-term care stay and you had a long-term disability policy, That doesn't cover this. This doesn't cover a long-term care stay. Medicare will cover the first 100 days if you move directly from a hospital into a long-term care facility. The first 20 days are paid in full. The next 80 days are, there's a significant copay. Health insurance does not cover long-term care stays. Self-insurance, I'd like to change that to self-funding because it comes out of our pocket and our portfolio. And HSC has um, a program that they do, a financial plan that they run, and they use the software that they use will factor in with and without a long-term care or an extended healthcare stay to show the impact on someone's portfolio, and it's phenomenal, and I highly encourage you to use it. But the consequences of using self-funding and starting to liquidate portfolio is you may be top heavy in your retirement plan or your IRA, and so every dollar that comes out has got to run through your 1040 and your tax code, and you have to pay tax on it. Or it could be the wrong time to liquidate a portion of your portfolio to pay for a healthcare claim. Um, it can be consequential, and you could drain the future inheritance of your kids if that's important to you. And then family members, even the most responsible are not always prepared physically, emotionally, and financially to care for their loved ones. 53% of Americans who cared for their loved ones and lost income due to the demands of providing a long-term care service support, a caretaker support. I think we have another poll, don't we?
We do.
All right.
Let's launch this next poll. How do you currently plan to fund your potential long-term care costs?
I know which one I'm picking.
You know which one you're picking? I know which one I should pick.
Well, there's one you should pick and one I'm going with the odds here.
Okay, let's see. We are getting close to the number of people on the call, and I'm going to end it in 3, 2, 1. All right, here's the results. Bob, you can tell us all about them.
I'd have won some money there. Not sure. It's a tough decision. It's visualizing yourselves in that position is really difficult. Um, but and it's easy to just punt down the road. So not sure is why we're doing this call so that we can lay out all of the options, align the ones that make the most sense, and it's all personal. This is extremely personal planning. What do you want it to look like? That's our role, is to help Nicole and Kelly and the whole team determine what's the best solution based on what you say is important to you. So self-insure is self-funding. It's $100 dollars. You're paying for it. Believe it or not, ultra high net worth clients hedge this risk because they get leverage, and they'd rather have somebody else paying for it than them. We'll go into more details on that later, but it's a very personal conversation. It's not something that everybody just gets excited about thinking about or talking about. It's a difficult but once you get involved in the conversation and you see the logistics of it, it's good planning. Next slide, please. So benefits of private insurance, and on the right you'll see source of funds. And it's kind of hard to read, so I'm going to lean forward. But the largest source of funds for funding long-term care is Medicaid. Medicaid is to qualify for long-term care for Medicaid, you have to have spent everything that you have except for $2,000. Now, this doesn't factor in the future income that you have from either a company pension or Social Security or both, because they're going to use that to offset their costs. But you personally can't have more than $2,000. And and then your Social Security payments and your pension payments go into a trust that is then turned around, and that trust is sent to the facility, and Medicaid pays the difference. So give you an example, if it's $10,000 a month and your pension and your Social Security total 5,000 a month, they're going to take the whole five, and then Medicaid pays the other five. That's how that works. And that represents, it says 40% of all costs for long-term care are coming from Medicaid. It's also about 40% of each of Indiana and Kentucky's budget, Medicaid budget. And that's went up from 34% 5 years ago. So it's went up 6% in just 5 years. And this again is this surge of people turning 65 and older that are qualifying for Medicaid and going on Medicaid. So private insurance only represents 9% of the of where the premiums come from. And the out-of-pocket is 22%. So what's the benefits of private long-term care insurance? And we'll get into the types of that and what all that means later. But it provides certainty. You know that if you have a long-term care claim, you know exactly what your benefit is at any time. It avoids the physical and financial dependency of family and friends because you have resources to help. It protects from it protects hard-earned assets. So if you have a portfolio, we like to call it portfolio protection, that if you did have a claim, your portfolio is protected, that you don't have to make a poor timed transaction or a transaction that is going liquidation that's going to cause massive taxes. You can maintain choice of where and who you receive care from. That's a big deal. Assures high quality care at an affordable price because you can shop who you want to go to, where you want to go, not which ones approve and take Medicaid. So it gives you more options to stay at home. If you have the resources that are coming in on a monthly basis, you can stay home longer. So you can maintain your independence, you can maintain family harmony. I can't overemphasize that importance. Enables your family to supervise care instead of providing the care, so they can supervise the services. Most all that I know of, private insurance companies have what are called care coordinating teams. And in Indiana, I'm just going to use an example. There's a company in Indianapolis called One America, and they have been doing this for 35 years. They have a care coordination team that is just unbelievable, and they will help family members find, and Nationwide does it, most of them do it, but they'll help you find the right fit, and they'll do all the legwork for you. They've been doing this for 35 years. This could be the very first phone call you've ever made in this area, or your kid or your grandkid is made in this area, and rely on their experience. So care coordination is extremely important. And you're transferring the risk. Now, one thing that's not on here that I think should be on this list is the leverage that you pick up by having private insurance. You're not just putting $1 in for a savings account and then you have $1 of LTC benefit. Depending on the type of plan you have and the inflation rider that's on it, your leverage with some is just massive. It could be, if it's an investment type product, it could be 10 to 1 by the time you go on claim. So for every dollar you put in, you could have 10 times that in benefits. And these are all tax-free benefits. Next slide, Leslie. So for those of you who run companies, are CFOs, controllers, or our own companies, here's all the tax stuff, and you can rely on Harding Shymanski for backup and support on this. But we tried to cover it all, and I'll go into a little more detail on some of the planning that I've seen and using this, because at the end of the day, a qualified long-term care plan is a healthcare plan. And it can be treated very much like a healthcare plan. So you have basic, what we call standalone traditional long-term care, which is truly like a health insurance policy. And we'll go into that in more detail in a little bit, ranging to policies that are on life insurance or annuity chassis. And each one of them, the life insurance has a long-term care component, which is deductible. And now an annuity doesn't, but it has a tax advantage if you have annuities that have high gains, and we'll go into that as well. But so let's go cover the boxes here. So if you're a W-2 wage earner, and you contribute to a long-term care policy, and we're just going to call this a traditional long-term care policy, you can deduct your premiums as a medical expense, but you have to fit some certain criteria. So and there's been conversation that they're trying to make this deductible like an IRA account or an HSA account pre-tax. I think they should, because the direction that some of the states are going, and I'll cover that in a little bit, are a little problematic in my opinion. Is I don't want to shift my risk over to the state and have them do a payroll tax. But the state of Washington, well, let's cover it right now. State of Washington passed the Washington CARES Act a couple of years ago, and they put in place a 53-cent payroll tax with no cap to any W-2 employee in the state of Washington. And for that, they got a 1-year, $36,000 long-term care policy that has inflation to it. But let's do the math here. 1 year, 36,000. You saw the numbers. That'll cover somebody for 6 months. But they're trying to shift the burden off of Medicaid. So other states saw this, but you could exempt out if you had your own private plan. You could exempt out of this payroll tax. And that pretty much shut down every insurance company in America because they couldn't process the applications fast enough. That's how much they wanted, the citizens of Washington wanted to avoid the mandated payroll tax. There are 14 states right now, Indiana and Kentucky are not two of them, that have pending legislation or fact-finding missions to enact. And the state of California's plan is really close to being approved, and it's a 2% payroll tax. And the 2% will get you $144,000 of care. It hasn't been approved yet, but they're working on it.
Hey, Bob. I
Yes,
just had a question come in, and I'm not an expert like you are in this. So I wanted to ask it. I think it pertains to this slide. And if you're going to answer it later, we can go there. But I wanted
sure.
to ask, can you explain further what you mean by leverage and maybe use some math examples?
I will cover that on the next
Perfect.
couple slides, okay?
Awesome. Thank you so much.
In great detail.
Perfect.
So when we say W-2 employees, if your medical expenses, your insurance premiums, your long-term care premiums all add up to more than 7.5% of your AGI in 2025, you can deduct up to, if you're 70 or above, 65 or above, about $5,000 of that long-term care premium. It's not it's hard to get to, and it's not a whole lot, but it's something. If you're self-employed, it's treated as health insurance and it's fully deductible. So if you're a 1099 self-employed person, you can provide a long-term care policy for yourself and your wife and your spouse, and it's deductible. But it's only deductible while you have 1099 income, self-employed income. C corps are different. If a C corp provides it for an owner, shareholder that are employees or any employee, it's 100% deductible to the C corp and 100% tax-free to the recipient. It's an anomaly in our tax code, and so we do a lot of planning with executive benefits because there's no taxable event to the client, and it's fully deductible. So it's used like a golden handcuff type thing or executive reward type program for the people. And because it's what's called a non-qualified benefit, it's completely discriminatory. They can pick and choose whoever they want to do it with. Partnerships, LLCs, and sub S's are treated just like W-2 or not, just like self-employed. But for employees, it's 100% deductible with no income to the employee, no income tax. So it does not show up on their their W-2. So if the employer wanted to put $5,000 in a long-term care plan for their employee, it'd be fully deductible and completely tax-free. That's how, anytime you get something like that, it shows you how much the government wants you to care for yourself and self-insure it, or not self-insure, but insure it. Let's talk about annuities a little bit. And I don't know if our group knows a whole lot about annuities, but annuities are investments issued by insurance companies that are tax deferred. Non-qualified annuities are not IRA money or not pension money, just regular savings money. So it's like a CD that's issued by an insurance company under certain circumstances, always tax deferred, but then taxable when they come out. And what we see is, because of this bull market that we've seen for so long, a client, we just did this one, so I use it as an example. The client had a $125,000 investment that had grown to almost $400,000. So she had, was that $275,000 a gain? That's the good news. She's never paid a dime of tax on that money. The bad news is, if she wants to take out anything, it's the first $275,000 are going to be taxable. And nobody ever does that. They just end up dying with them and passing them to their kids, and the kids get the tax bomb. But the Pension Protection Act that was approved years ago had a feature in it that if you move that annuity into what's called a Pension Protection Act LTC qualified annuity, you could use, and it's used for qualified long-term care expenses, that distribution comes out tax-free. So I'll give you an example. In this case, she was healthy. She was 68 years old, and her $382,000 long-term care annuity provided $16,000 a month of long-term care benefit and a total pool of over like $1.2 million. So there's the leverage, Leslie, just for that annuity. She put in 432 or 482, and she has a long-term care benefit of 3 times that. And no taxes. If it comes out for a long-term care expense, it's tax-free. So she was ecstatic. There was only like 3 health questions for her on that because it's not traditional long-term care. She's funding a third of it with her own money, of which, if she took let's say she had to take a $120,000 distribution for a long-term care stay, that's that's going to be eroded by probably 30% for taxes. So with this, she takes out 120,000 and that's all she takes out and there's no tax. So there's significant advantages to using a qualified long-term care annuity if the situation is right. And she was single and she wanted the coverage for so that nobody had to worry about where the money was going to come from. But with those annuities, you can also add a spouse to them as well, and you can cover both of the husband and the wife with the same product and the same monies, and so they'd be feeding out of the same pool. And typically, one goes in longer than the other, or one goes in and the other one doesn't. But you know, it's better than, that leverage is better than not. Next slide. So traditional long-term care or standalone long-term care was almost 100% of the market. I'm going to say 90% of the market until about 2010. And what happened was the baby boomer surge, and we were coming out of a high interest rate environment, and pricing of insurance policies are determined by mortality, or in this case, morbidity, also on lapses. They factor in a lapse ratio of clients that just decide to drop it, and interest rates. Well, we saw interest rates go bottom out. Nobody was surrendering these policies, and the cost of long-term care services continued to inflate. And I'm going to throw a company out there that I think everybody's heard of before, but Genworth, which used to be GE, Genworth was the largest provider of traditional long-term care policies. Last year, because I follow this, last year they took in $6.3 billion in premiums, and they paid out 6.28 billion in long-term care claims. Nobody surrendered them. Everybody kept them. And so what you get with Genworth is this product that was totally mispriced. And it had an inflation rider on it. So it kept going up, and you could have a lifetime benefit. I mean, everything that they could do wrong, they did wrong. And almost every other carrier, to be competitive, followed their trend in their pricing. So long-term care adjustments in pricing from 2010 to 2025 have been significant. And clients who have long-term care policies that they bought in the early 2000s or even the 1990s, they're getting 50, 75, 100% rate increases. They send them to an advisor like Nicole or Kelly, and they send them to us, and we're like, we still can't beat them. They're still underpriced. But the states won't let them raise the prices fast enough. But it is, from a pro side, it's the cheapest way to get into having a long-term care coverage. It is an annual premium. It's very much like health insurance. So it's an annual premium that that is fairly low, a couple $1,000s a year. It has inflation protection. The premiums may be deductible. We talked about that on a previous slide. If you're part of a partnership program, I think Indiana definitely has a partnership program. I'm not sure about the state of Kentucky, but if you're part of a partnership program, you can protect a good portion of your assets by having a policy that is part of the partnership program. It provides the most leverage. So you could have a $300 a day benefit and only be paying $4,000 a year. And that would inflate. The LTC benefit would inflate, and so would the premium eventually. But it's the biggest bang for your buck. Now the cons: premiums are required until you file a claim. So it's just like health insurance. It's a pay for the rest of your life. There are very few, if any, shorter single pay options for traditional long-term care now. Possible rate increases should be traded to eventual rate increases because you'll get them. But here's probably the biggest feature that besides the rate increases that clients don't like, it's a use it or lose it. If you never go on claim, there's no residual benefit. And they're reimbursement only. And we'll get into what reimbursement is, but basically, if you have a claim, they'll reimburse you for the claim, as opposed to indemnity that if you go on claim, you're qualified to do the 2 of 6 ADLs, they just start sending indemnity companies just start sending you checks. And we'll go into greater detail on that later. On the next slide, actually. So asset-based long-term care. So as traditional long-term care began to fall out of favor, companies shifted to the what's called asset-based long-term care. And basically it's a life insurance policy with a long-term care component. And they use the life insurance policy because the chassis has some of the greatest tax benefits in the code. So, and it provides guarantees. So from an asset-based long-term care standpoint, the pros are, number one, everything is guaranteed. The benefits are guaranteed. The premiums are guaranteed. So there's no rate increases. Once it's funded, you're done. If you had a 10-pay version of this and you're 6 years into it, there's no rate increases. It is what, if it's $10,000 a year for 10 years, that's what it's going to be. The benefits are 100% guaranteed. So the ability to get premium back if needed, they have what's called a return of premium rider. Now this has evolved from back in the, in the mid 2005s to 10s, it was 100% return of premium starting in year 3 to now it's anywhere from an 80% return of premium rider to a 100% return of premium rider, depending on if you want the luxury of knowing that you could pull the trigger anytime after so many years and get all your money back, no questions asked, or I want the maximum long-term care benefit that I can get. Capital stays with the family. So if you don't use it for a long-term care stay, there's a death benefit that is always equal to or greater than the original investment. So live, die, or quit. If you live and you never draw on it, if you die, there's a death benefit. If you have a long-term care stay, there's significant long-term care benefits. And if you quit and you want your money back, that's a feature as well. They're very simple to understand. You can do a 1-pay, 5-pay, 10-pay. Some companies even allow for a lifetime pay. And they're brand name companies like Lincoln and Nationwide, One America, Securian, New York Life has one that we support as well. You can pay with cash or you can transfer old life insurance policies into it, and add cash if you want. It's a limited underwriting. There's less underwriting than a fully underwritten long-term care policy. So you can have a couple nicks and scratches and still get approved. And you have the ability to pick a carrier. And I think it's important. I'm going to get into this on another slide, but so there's 2 different kinds of benefits when you go on claim. There's reimbursement, which means that let's say you have a $10,000 benefit. In order to maximize and get the whole 10,000 out, you have to incur $10,000 worth of bills. So you have to be able to support the claim. And then they'll reimburse you for that claim. That doesn't mean you have to write a check for $10,000 and then they send you 10,000 back. That just means that you can verify that you had $10,000 in claims and they'll send you the 10,000 back. The other one is called cash indemnity. And once you qualify for 2 of 6, you tell them how much you want sent. And your bills could be $3,000, but if your full benefit's 10,000, they'll send you 10,000. And you can spend it any way you want. And a lot of people prefer that because of it allows them the flexibility to pay a non-licensed care provider, which could be their daughter, their granddaughter, their grandson, could be anybody they want. But let's talk about some unintended consequences. So I'm at home, I can't work anymore, and my wife is still, running mission control, CEO of the family, but all the things that I used to do, somebody's going to have to do for her. And that's going to come with out-of-pocket costs. If we had a reimbursement plan, I can't turn in our lawn being mowed or the shovel being snowed or anything like that. But if I have an indemnity plan, I can. I can use that money. She can use it any way she wants. So we like to see some prudence here is the elder abuse concerns of everybody getting cash indemnity. We have to be realistic as to what are who, could this person be at risk and could somebody take advantage of them? And then in that case, reimbursement makes the most sense. The cons are the best leverage is when it's a lump sum investment. As you spread the payments out, the benefits reduce, but you still pay the same amount in over 10 years. But it's just a convenience, cost of convenience. Point of entry is typically $50,000 or more to get in, unless you do a 10 pay or a monthly pay or a lifetime. And then they're not as attractive when you get to about age 73 or 4, the leverage, and we'll talk about the leverage. So a 60-year-old puts $100,000 in, they'll start out with probably a 4.5 to 5 times leverage. So they put in 100,000, they have $100,000 or more death benefit, and they may have $500,000 of long-term care pool. That's going to inflate, and by the time they're 85, that $500,000 pool would be more like $1.5 million. And their $5,000 a month monthly benefit would be more like $15,000 a month. And it's a rough estimate. But that's the leverage. Their original $100,000, their family's always going to get that back, either in claim or death benefit. But so all they're forfeiting is the use of that money and the income that money would provide, or the growth that money would provide. But that's what I mean by leverage. Next slide, please. Accelerated benefit riders. Now, this is a true life insurance policy where death benefit or legacy benefit is more important than long-term care benefit, but you can kill two birds with one stone. So it's a guaranteed benefit, guaranteed rates, very much like the last slide. Monthly LTC benefits could be largest of all of the options because you can buy a large death benefit and add this rider of 2 or 4% of the death benefit, but it only lasts for 50 months. Largest death benefit option, as we said, premiums are never lost because the death benefit leverage, we use guaranteed products for this, so there's no surprises if the company changes their internal costs. It doesn't matter. Everything's been guaranteed. It's flexible funding, can pay with cash, or you can transfer in existing policies. And some of the policies even have an indemnity benefit, which we like. The cons are the surrender value could be very much less than your premiums paid. So if you had to exit, you needed the cash, it's not going to look as good as an asset-based long-term care policy, and it's probably going to cost more. And it's a fixed benefit pool. There's no inflation rider to it. So whatever your death benefit is when you set it up is going to stay the same. Next slide, please. So things to consider, daily or monthly benefit. I shared some numbers with you, and the average cost was in the state of Indiana for a semi-private room is 120,000 and home health care is like 60,000, that's five or $10,000 a month right there. So, factor that in. Benefit cap. I will say, when we're doing the planning, we always look at a couple ages. We look at today, but we really look at between ages 80 and 85 because the average claim starts about 82. That's the statistics that were put out. Elimination period is like a deductible. How many days do I have to be um, approved for LTC, the two of six, before I'll start receiving a benefit? And some have 0 day for home health care and 90-day for in-house care or semi-private care or private care. They don't care. Um, the cost is going to be the cost. So look at that elimination. Some say if you make it 90 days and you're still on claim, that 91st day, we're going to send you 4 months benefits. And so we're going to pay back the 3 months that we didn't pay you and then start paying you from there. A couple carriers do that, and it's a nice touch, but it does stop them from having to send out a check and then 2 months later you're back no longer qualified. Inflation, most of them are 3 or 5%, simple or compounded interest. And we just look at different metrics and based on age and gender, which one gives us the biggest bang for the buck. Payment options, obviously, we got to figure that out. Is it a single pay, all pay, or something in between? Potential changes to ongoing premiums, that really comes into play on the traditional long-term care. Non-forfeiture provisions, all policies have non-forfeiture provisions, which means if you've paid in premiums, you're going to have some kind of residual benefit. Exclusions are what don't they cover? And we want to know about those. Indemnity or reimbursement, we talked about that, and that's how you receive the money. Chronic illness, is it temporary or permanent? It's an insurance contract, so we gotta like dot our I's and cross our T's and make sure we know everything. And there are a bunch of carriers that sell this stuff that I've never even heard of, and they go door to door. So if you're looking at a plan and you just don't know, send it to us, send it to our team, and we'll look at it and give you our opinion. All right, I think we got our last poll.
We do. Let's see. What is the biggest barrier keeping you from finalizing a long-term care plan? Okay, it looks like we are about almost there. I'm gonna let it end in 3, 2, 1. And Bob, I will let you speak to these results. I think what you have said fits the answer.
I would have put money on hard to start the family conversation. Um, that's encouraging that 93% of the people thought that wasn't the biggest. It is so hard. It can be and awkward for sure. But not sure what best fits is why you would want to sit down and consult with somebody. Cost and affordability, for some, it's not an option. It's just the costs are too much, and I really believe that. Or hedge and get as much as you can afford that doesn't change or disrupt your lifestyle. But repositioning some assets for those who have the option and the ability, I think you'd be surprised as to the affordability and to know that that money's always there if I need it. A lot of the planning we hear as well, I've got this money over here in case of an emergency, and it's our, safe, it's the safe money, and it's like $200,000-300,000 in CDs or wherever it's in. They never touch it. They're never going to touch it. They probably would never touch it. And that 200 could be 1.2 million of long-term care benefits if they needed it. So that's the worst thing is somebody that comes to us and it's too late. Their health is to the point where they can't get it, and then it just breaks my heart. And we try to give them as much uh, many options as we can. But the carriers, they're in it to make a profit as well, and they just can't take everybody. Um, Next slide. I even had somebody call me and say, "Hey, my mom's about to go into a nursing home. Can I get long-term care insurance on her?" But I said, "No, it's too late." Um, so the most important thing is what works best for you. This is too important of an issue to be left at chance. I've seen some memes or things that is luck is not an option. Um, Chance is not an option. Uh, when I say we, Harding Shymanski has a full service team of professionals. They'll sit down with you, show you all the options, show you, pricing. The earlier the better is the easiest way to put it. It's more affordable. Long-term care is just the opposite of life insurance in that with life insurance for 100 years, forever, women live longer, so their rates are less than men. With men, long-term care insurance is cheaper. Their premiums are less by about the same offset because women live longer, they have a longer morbidity. And if you look at the statistics, um, it's like 65-35 as far as males versus females who are in long-term care facilities. Decision can be made in a vacuum. Trust your resources. Sit down with them. I'm sure you all do this without, you don't charge a consulting fee to sit down and explore options. So um, absolutely ask questions. And we can help in any way we can. So Leslie, do we have any other questions besides the leverage question? Because I think that's our last slide.
Okay, we do have a couple of questions here. Maybe we've got time for one or two. We had a question that said, you mentioned setting up a golden handcuff type of plan. Can you share an example of how that might be structured? What happens if the key employee leaves?
With long-term care, it's really simple. Life insurance is you can make it as complex as you want with long-term care. What they walk away from is future contributions. So if you made this agreement that you stick around, we're going to give you $5,000 a year in a long-term care policy. It's yours. You can make your spouse the beneficiary, and it'll be fully funded when you're 65 years old. And here's what it means to you and your family. And if they leave 4 years into it, they don't get the extras the next six payments. That's about as much of a handcuff as you can put on something like this when you're taking a full deduction.
Hmm, okay, thank you for that.
Uh-huh.
Um, and we've one last real quick one. Can you give us an example of why it would be hard to start the family conversation? Where do you see that most people have the trouble starting those conversations?
Well, I have most of the barriers lie within us. So we're just uncomfortable starting this conversation. I've counseled people, I've had to do it with my mother-in-law. She's starting to have some cognitive issues, and we had to have that conversation, and I just started it. Have the courage. What's your plan? Is exactly what I said. And she's like, "What do you mean, what's my plan?" And then I said, "Well, Donna, you're 87 years old. What's your plan when you forget where your keys are and you don't know where you're at, and because that's going to happen." Well, I don't know. And we had had this conversation a year ago. So it's having the courage, but also forward thinking. How do you want this called? So if it's a conversation you're going to have with your parents, that's one thing. If it's conversation that you're going to have with your kids, that's a whole different conversation. And you're doing this for the family. My mother-in-law lives in Florida. We live in Indiana. My brother-in-law lives in Georgia, and my sister-in-law lives in North Carolina. So nobody's within 5.5 hours. Well, we all take turns, but when we get to crunch time, we got to have a plan. And so we have it in writing, we have a plan. She signed off on it. And whether she remembers it or not's another story. But having the courage to just start the conversation because it's all out of love and it's all out of what's in our parents' or best interest or our kids' best interest when we have those conversations. But a lot of times the barriers are just awkward and they're all within us.
Mhm. I can appreciate that very much. Well, Bob, thank you so much for your time today. We appreciate it. And we thank you all for attending. Again, this is our last webinar in our fall series. So watch for tomorrow. An email will come from me. It'll have the recording and your CPE links. If there's anything you need, you can respond to that email and I can get you connected to Bob or anybody in our group that might be able to help you with any of the questions that you might have. All right. Have a great
Thank you,
rest of your
Leslie.
day. Thank
Thank
you.
you.